Everyone for this wonderful workshop on reservoir economics. And the application part is MS Excel. So everyone knows the significance of MS Excel these days. Probably one of the best tool to analyze data. And a lot of softwares were developing based on the capacity and potential outcomes of MS Excel. So it is like even if anyone wants to learn a software, so prerequisite could be MS Excel. Like if you have good grip on this particular tool, then it will help. Most of the softwares can be understood in a proper way. So even for reservoir economics, so currently this could be one of the best potential tool to understand the kind of concepts that we integrate in reservoir economics. So what exactly is reservoir economics? See, reservoir economics is the one comes under business. Like generally we talk about profit. So economics is directly related to profit. So how best you can do the business so that the profit can be maximized, optimum production, like how best you can able to analyze your parameters or data or else the methods that you're going to adopt or the decisions that you're going to take. This all will affect the future generation of money based on the project or the kind of implementations that you're going to take on. So when it comes to reservoir economics, so reservoir is one among the most important area in petroleum engineering, oil and gas industry. So we have oil as well as gas, both industries are there. And if you know about reservoir engineering, that could be a very good, starting step to understand the economics. But it is not that you need to know deeply about reservoir engineering to move towards economic side. But of course, always it will be helpful if you have the knowledge of reservoir engineering. So that is one thing which we have to focus on. So reservoir parameters are considered over here to understand the part of economics. So that is one thing. So let us get into this area quickly. And this particular presentation is about the concepts that we are going to handle in the 1 week training program. And definitely it is very important aspect in industry wise. When you move up in the ladder of oil and gas industry, you are supposed to understand the part of economics. Every industry is based on business and profit. So without profits, no one can start business. Without getting any information or certainty related to profit, then it is like the industry will take back step uh, unless you have proper information regarding the business generation outcomes. So what exactly we are going to discuss today? First of all, we need to know why reservoir economics is considered as an important factor in oil and gas industry. The purpose of it. So what could this particular aspect, like this concept, will help you to progress business forward. Forward business means like you are going to take business every day. Like every day you need to start understanding the economic work. Production will be something which is happening parallel to it, and investment will be taken care of. Production, exploration, development, delineation, all these parts are there already, but everything is connected to economics. Like today what you are investing, tomorrow outcome is the one which will make your industry to go forward. So it is like the investment what you are investing that should satisfy the needs of running the business. There are a number of parameters that you are supposed to focus on. Oil and gas industry is like joint venture. Like you will be having number of industries that will be integrated to progress this particular business to go forward. Like joint venture, you have different industries connected to oil and gas main business. So they are all doing business everywhere. Economics plays. Even though imagine if you have crude oil at a particular location, if it is not economical, industry will not take that project. So this is what the significance of the economics is. Even for development project, even for exploration project, any project, first of all, they should get the report of economics in such a way that if you invest money in exploration, that you are going to get information in written in such a way that you can start the project for profit. So without profit, like without certainty in profit, no one will start moving forward in the business. When it comes to oil and gas, obviously this is the most important way, because the business scale is larger. So you need to go on estimating each and every parameter. Of course, it will take a lot of analysis. It depends on the data that you have. You have to connect towards your monetary aspects. All this together, you're going to construct a report in such a way that this report will tell you whether you can able to take the step forward in the business. So this is what the significance of economics. It's like, fuel to run a vehicle. Like without economics, your vehicle will not move forwards. Like without hoping profit that is going to get in future, we are not going to move forward in the business sector. So that is the purpose of reservoir economics. So we are going to discuss about some concepts, key concepts. And today I'm going to give you some important information about NPV, IRR, and if possible, sensitivity analysis. So what is NPV? Let us going to discuss further one by step by step. NPV means net profit volume, IRR, internal rate of return. So let us go into that. So the purpose is to take decisions. The simple thing is decision. Reservoir economics serves as a decision-making tool for oil and gas companies, governments, and investors. It helps them to determine whether to proceed with the drilling, development, and production activities in a particular reservoir. Since we are talking about reservoir, so we will be handling the data of reservoir. So there are a number of parameters that were connected with economics, and we are going to integrate economics with reservoir engineering, and we are going to generate the report based on that, whether we can go ahead. It is like decision making. Whether to go forward, that's a decision making thing, whether it is we are ready to go forward or not with the report that we have. So that is how we are going to show. It is everywhere step-by-step process. Like each and every time we are going to repeat these kind of iterations to get the information to make business progress. Or else, what are the things that we have to do so that it will help our business to move in other direction, where it will help you to create more profits. So all the time, this analysis is continuous. It's a continuous process from the start of exploration to the abandonment phase of reservoir. This reservoir economics will be continuously integrated, and it is supposed to be analyzed and monitored. Finally, it has to be implemented. So based on the decisions that they have taken on part of this analysis. So what are the things that are required to go with this concept? First of all, reservoir data gathering. Since we are talking about reservoir engineering, what is reservoir data? See, geological data, reservoir engineering, well testing data, like that. We have different data are available. Geology, the kind of rock samples, lithology, compressions, folds, faults, whatever geological data that you have, that we are going to collect. We are going to, and we are going to normalize exact data which is required for operation. Here the thing is operating activities. Why? Because business will be operated. So for operations, what are the data that is, it is not the data of everything. Whatever data to understand reservoir engineering or anything, no. For operation of business, what are the data that is required from geology? That has to be taken out. Then next comes reservoir engineering. We have number of data like porosity, permeability, capillary pressure. So you know a lot of reservoir engineering data. Of course, if you are coming to reservoir economics, means probably you will be having some idea on reservoir engineering. So it is not about that all the reservoir data that is required over here. We require such data that is connected with operating activities of business. So that is what we are going to take. We are not going to study completely about reservoir. We need certain data, production data we need, operating data we need. These are the data, these are the continuous operation activities that will be carried on in the business, so that every time you need to talk about investment. So we are going to invest on something that is operations, and these operations has to continue. For that, you may not need certain data which are not related to this operation. So that data is not required. We need certain data which are required for operations of the business. Then comes well data. So since if you are handling a well project for economics, so you need to have that data. Understand the reservoir size, depth, permeability, porosity, fluid properties, and pressure dynamics. If these are connected to operations, then of course these data are also required. So since ultimately operations and productions, these are the ones which we are going to concentrate to continue our things forward. Then comes production forecasting. For production forecasting, what are the things that we are going to discuss? Production forecast is something we are going to, estimate future production, which is connected to uh, uh, profit of your business. So in that way, what are the things that is required? Today, you might have some data, but how you are going to generate future data? So how you are going to estimate production for future terms? Based on that, how economics are connected to it. So all these things are connected to for production forecast. So that also we are going to do with production decline curves. So how to generate these curves, how to forecast future production by production decline curves, and how Excel will help you to understand this. And more than that, what could be the best economic production year that will help us to continue our production. So based on that, we can analyze future operations. Like if the economic production is ending nearby, then you can do certain activities in workover, enhanced oil recovery, improved oil recovery, anything you can do so that the production curve will increase. So economics will help you like an alarm. So it is going to tell you like so and so will happen at so and so time. So based on that, the decisions will be taken. Ultimately, it will come towards your decision making strategies. Based on that, you have to take steps in operations and production so that the production will become effective and the results will be efficient. And account for variations in the production due to reservoir behavior and well performance. Always heterogeneity is one among the most important factor in reservoir engineering that you are supposed to understand. So if your reservoir is more heterogeneous, then the data will also becomes more heterogeneous. So based on that, you need to estimate the production forecast, like whatever forecast you are doing it, that depends on heterogeneity. And for that, you need certain tools to understand this. So Excel will help you in that direction also. If random data is there, how to make predictions by using random tables, like that also we are going to do that. And cost estimations. So identify and estimate all costs associated with the reservoir development. Here in economics, cost estimations are connected with general economics. Like imagine we have different costs are there, average cost, marginal cost, opportunity cost, like that. These costs are related to oil and gas industry also. So for that, you need to understand the type of costs and how these costs are connected with other costs. Cost itself will tell you how your operations are progressing, whether it is progressing in a way so that you're going to get what is the outcome that has been predicted. If not, what are the things that can be done? Always we have a choice. So it is like decision making. If something is not happening according to your predictions, then you have always plan B. So you have plans, but how to decide that plan A is suitable or plan B, that depends on your reservoir economics. That can be understood by understanding these estimations. Costs include drilling completion, operations, maintenance, and any environmental compliance expenses. So that is one thing. And the one which we are going to discuss today is net profit volume, which is the most important one. So calculating net profit by subtracting the present value of the cost from the present value of revenue. A positive NPV indicates that the project is economically viable. What is NPV? That we are going to discuss. And what is internal rate of return? So internal rate of return represents uh, the value of a project. At the same time, NP is also there. But I will show you with example and I will let you know rather than telling what it is. So it will be easily understood. So NPV, this is how we are going to estimate net profit volume. This is a kind of important parameter every economist has to understand. It could be oil and gas industry or any other industry. NPV is the one which will make you to understand. Why? Because inflation is the one that we are going to witness most of the times. Like the value of dollar will reduce when year passes by. Like today, the value of $1 will not be the same in the next year. It could be less. Why? Because of inflation, or it could be of any other thing. So we say that kind of mechanism as discounted value. So the value of $1 could be 0.9 cent in next year. That could be even lesser when it comes to third year. So every time the value of dollar will be reducing. So that has to be discount. Like discount could be of 10 percentage or 1% or 12%. It could be of anything. So the prediction of this discounted percentage will be done by economists. Based on that, the future income will be estimated with discounted price. So that is equivalent to NPV. NPV means net present value, the present value of future income. Imagine you are expecting $10,000 in next year, means today the income of $10,000 will not be 10,000, it will be more than 10,000. Today the value of 10,000 in future will be more. So in that way, it could be even when it comes to backside, so value will be more. When you're progressing further, you're forecasting further, means if you are getting the value of today's 10,000 tomorrow, means the value will be less. The value of $10,000 today could not be equivalent to $10,000 in the next year. It could be maybe 9,950 or something. So $50 it could be discounted. This is dependent on the percentage of discount. So every year we will be predicting certain discount percentage. Based on that, the value of your future income is estimated, and definitely it will be less than the amount of what you are getting today. So if you cumulate all the values, then you will be getting NPV. So you invested in a project of some bulk amount, then you will be getting outcomes of this project in each and every year, next year. But that value, what you are predicting today, will not be the same. It has to be adjusted with discounted percentage. Based on that, the value will reduce for every year. Okay, and I am going to give you a small example based on that, so that you will be knowing that. So let us try to understand. It's a small example. Suppose you are considering an investment in an oil production project that requires an initial investment of $100,000. So this is the one you are going to invest at the start of business. Over the next 5 years, the project is expected to generate the following cash flows. So you are going to get cash inflow. The one which you are going to invest is cash outflow, that is $100,000. So first year inflow is $30,000 from the income that you have invested from $100,000. At the end of first year, you got cash inflow of $30,000, which is profit of 30,000, but it haven't been equivalent to 100,000 which you have invested. Second year it is $40,000. Third year is 35, 25 in the fourth year, and fifth one is $20,000. This is what you are expecting, you are forecasting. But this is without discounting the price of it. Like, you are just invested and you are expecting this income to get return exactly like this. But always the money value will reduce when you pass year by year. So imagine with some predictions, the discount rate you got the information that every year the money will be reducing with 10%. So you need to adjust the values of your outcomes at every end of year, that with your discount rate, that is with 10%. Then the value of first year will not be equivalent to $30,000, but it will be 10% less than $30,000. In the same way, year two also, it will be even more less. It could not be 40,000, it will be less than, 10% less, but it will be adjusted with year also. It came in second year, so cumulative reduction will be there. So that you are supposed to calculate. So whatever outcomes that you are getting over here will not be the same. It will be less than that, because the money value is reducing with 10% every year. So if that is the case, how many years are required to reach your $30,000 that you have invested. You are going to get that money back. So that is how, whether it is 5 years production is enough. In this, if you see 30 plus 40 plus 35, like imagine at the end of 3 years, 30 plus 40, 70 plus 35, it is 105, like $105,000. So at the end of third year itself, you are getting whatever you have invested. But if you discounted this amount, you will be getting the real income of what you are going to get it. So let us see the solution. So this is the one with 30,000 NPV. So if you have calculated the value of 30,000 with the discount price, this is the formula that we are going to use. So I'm going to show you $30,000, that is the year one, and 1/1 plus discount, that is 10%. So 10% can be written as 0.1 power the year number. So this is the first year, so power 1. So in that way, you have to calculate for the second year. So here it will be 40,000 by 1 plus. I have given all the values as 30,000, but it should be like based on all these values. Then you are going to get for the 30,000, the value is 27,272. For 40,000, this is not 30,000, just I have to replace the value with 40,000. You are going to get the value as 33,057, and 35,000 you will be getting as 28, and 25,000 it is 18, and 20,000 that is 13. So right now, if you have added these values, 27 plus 33 plus 28, it will not come near to uh, 100. It could take one more amount. Like here it is showing 4 years it is required to reach your $100,000, but earlier prediction it is showing around 3 years. So this is how NPV will help you with the discounted price. How much years it is required to reach the amount that you have invested, that can be estimated. So since the money value is reducing, so earlier with the predictions we have 3 years, but with the discounted amount we are getting around 4 years. So overall, at the end of your fifth year, this is the amount that you are going to get. That is 121,936.65, which is a discounted amount. So when you have considered without discount, the money will be more. But this is actually the outcome of overall NPV regarding this discount. So the profit that we are going to get is $21,936 at the end of fifth year. So next comes internal rate of return. Anyway, I'm going to take both values in a real-time project. So to understand, how much, how we are going to estimate. That is an example to understand it, but it is not the one we are going to solve. So we are going to solve something in a clear way in Excel. So next comes internal rate of return. So right now we understood about NPV. It is the future income present value. So whatever income you are predicting in future, that we are discounting with the percentage of decline, and we are going to estimating with present value. When it comes to internal rate of return, this is even more important to understand how much time it is required to pay back the investment that you have done. So if you have invested $100,000, NPV will tell you the amount of income value, but IRR will help you to tell that how much time it is required to get that income back. You may have, outcomes, like these are the predictions that you may have, but these predictions based on that, how much how much time it is required to get your income back, and what percentage discount is required to reach this investment value, that also can be estimated by internal rate of return. So this is the formula that you are going to see. NPV value, see cash flow at any time by 1 plus IRR. IRR means internal rate of return. Actually, internal rate of return is nothing but the discounted rate. It could be in percentage, 10%, 20%. This is the value of IRR. And whatever value you should pick, that value of overall NPV will become zero. When NPV will be zero? NPV will be zero once you reach to your initial investment after discounting that price. So if you know that, then you will be knowing the value of IRR. So the value of IRR will be adjusted in such a way that NPV value will become equivalent to 0. So IRR will tell you the value of discounted percentage that will help your overall outcomes, which will be equivalent to your investments. Outcomes minus investment will be equivalent to 0 with the discounted percentage. So that value will be understood by that. So this is the example that today we are going to discuss, evaluating reservoir project, a case study. So we are going to understand this data, and based on that, we will be estimating NPV, IRR, like we will be understanding how best, whether this project is viable to accept or not. So first of all, let us see data according to 11 years production is shown in the table. So 11 years productions, year-wise we have up to 11. 11 year 1, year 2, year 3, under that up to 11. Estimate every year's NPV of the cash inflow from the initial investment of $100,000. So initial investment was given $100,000, and you can see oil prices were kept over here and production rate was kept over here for oil prices $50 per barrel, but oil prices were not same. So it is increasing every year, 50, 55, 60. In the way how it is increasing, it is increasing. And the production rate for each STB per day. So every day you are producing around 1,000 stock tank barrels. So 1,000 stock tank barrels every day you are producing. And when it comes to revenue, 1,000 stock tank barrels into 50. Why? Because every one stock tank barrel is equal into $50 in the year one. So 50 into 1,000 will give you every day cumulative amount of that you are producing. So that is 50,000 for first year, 1,000 into 50. 1,100 into 55 will give you 60,500. So this is for everyday revenue. So you are getting revenue for every day based on oil prices over here. Then finally, operating costs. These are the costs that were involved to run the business. So operating costs for every year also they have been given. So for each day, operating cost is 20,000. So that you are supposed to neglect. You have to minus from the revenue that you got. Then the remaining will be the amount that is the cash flow. That is the profit. So 50,000, like revenue minus operating cost, 50,000 minus 20 will be 30,000. So minus 100,000, why I kept is, this is the investment that you are investing on the project. Then the first year profit that you have witnessed is 30,000, like revenue minus operating cost. Second one is 60,500 minus 22,000, 38,000. Like this, we have calculated for all 11 years. So this is actually the net cash inflow. At the end of year, the cash inflow for every year is 30,000, 38,500. Like that, it has come up to 11 years. But there is some more thing that we have to understand. And estimate the time to return back the investment with a discount rate value was given as 2%. So 2% discount rate was observed for every year, and we are going to estimate at what year the amount you have invested have completely recovered. So this is the thing that we have to estimate. And first of all, at the end of 11 years, we need to understand how much income it is going to generate. That is one thing. Second thing is we need to estimate NPVs and real-time NPV as well as outcomes of this. This is the predicted values without discount rate. What is the outcome without discount rate? What is the outcome with discount rate? So that also we have to estimate. And the payback period. So what year you can pay back completely the amount that you have invested. After that, whatever income you get. If imagine you could able to pay back at third year, then the remaining all the incomes that you are getting is connected with profits. So you started to witness profit maybe after fourth year or fifth year. So from that year onwards, company will start generating profit. There is, you can see the profit. If it is increasing more, then the company business will progress forward. This is what exactly the predictions, and we are going to estimate the payback period at the end of what year we are going to recover completely the amount that we have invested. So after that, we can start witnessing the profits. Okay, these are the things that we are going to see in today's Excel. So I'm going to quickly share Excel sheet. I hope Excel sheet is visible. The table that I have kept over here, the same data, whatever you have seen that I kept over there. Thank you, thank you. So it is visible, I believe. Okay. So year was given, oil prices were given, and production rate was given, revenue, operating costs, net cash flow. These are the tables that I have shown. And the discount rate is 0.02, which is equivalent to 2%. So put 2%, that we can give it as 0.02. So let us keep the discount rate. So we are going to estimate NPVs for every year in this column. And this is the column I'm going to explain what is the purpose of this. I'm going to explain you. This will have some significance. This is cumulative cash flow. So cumulative shortcut cash flow that I will be explaining. And next to that, NPV, I'm going to use it with a short technique. And I'm going to estimate IRR. As I said, what is IRR? IRR is the percentage discount value that will help you to understand at what percentage discount your investment is equivalent to your outcomes, cumulative outcomes. So I'm going to discuss that. And payback period. So at what year, what month, what day. So these are the objectives that I'm going to discuss. At what year, what month, what days. Okay, these are the ones that we are going to discuss. So the formula for NPV, generally what we are going to use is equal to the cash inflow, that is 30,000 that you are going to select by 1 plus. So the discount rate that you are going to use is 0.02, close the bracket. So this discount rate, I'm going to use it for all the values. So I'm going to lock it by pressing function F4. So when you add dollars to this cell, then it will lock that value so that when you iterate it further, this values will take the same value as discounted. Power. So we have the value of first income, that is 30,000, that is G5 by 1 plus discount rate that you have to close in the bracket. Power, you're going to fix the year. So year values were here. So I'm going to fix the power here as B5. So I'm going to equate it. So you can see the value of $30,000 with the discount, it is not equivalent to 30,000. It is 29,412. So at the end of 1 year, the value of 30,000 will not be $30,000. It is 29,412. So this is the discounted value of your predicted income. So this is how we are going to estimate. So the first, at the end of first year, this is the value. And if I click it further, like I have to just double click over here. So I got all the values. You can see how the values have changed. So these are all connected with the discount price of 0.02, that is equivalent to 2%. So 2 by 100, that is 0.02. So 38,500 is not equivalent to 38,500. That is $37,005. So 48,000 will be 45,000, which is not equivalent to that. So these are the present discounted values of future incomes, which is not equivalent to your net cash flow. So this is what exactly are present values of future income. And cumulative of all this, I selected all the values of this. And I'm just going to Home tab and Auto Sum. So this is the income that I'm going to get at the end of 11th year exactly, with the discounted income. But when it comes to the real predicted value, if I have done auto sum, then you can see the difference between these two. So this is the one which is showing $9,62,500 which is the one that you have predicted, but actually with the discounted amount, you are getting the value of 8,31,000 um, $249. So, which is lesser than the predicted values because these are all the values which were discounted. So when it comes to accepting the project for 11 years, what is that we have to do is initial investment minus the total amount that you have got it, that you have to estimate. So let me just see the values over here. So what I have to do is simply I need to sum the value of initial investment plus the amount that we got it. So we got the value over here as $8,62,500, which is positive. Here we have to see whether the value is positive or not. In the same, this is about the real predicted values. But when it comes to the discounted values, the value you have invested plus the value that you have got cumulative. So this is also positive. So both are positive. Both values were observed to be positive. So you can go for taking this as a viable project. It is economical. It is going to give profits, but the profits with discounted value is 7,31,249. For the predicted value is 8,62,500. So at the end of 11th year, you can expect a profit of $7,31,249, which is positive. Then the decision is to take this project. So this is the one for 11 years project. Okay, that is one thing. Second thing is we need to estimate. Right now we have estimated all the values of NPV and we have cumulated and we have just taken the value of the profit. So right now we have estimated the profit over here, and let us see a shortcut form to estimate NPV is equal to NPV. Just type the function over here, and here it is asking you to type the rate. Rate is the one which you have discounted value, that you click it, just put comma, and the values that you want to get discount, just select all the original outcomes, close the bracket and enter it. So you can see the value of this one and this one are same. So right now I have calculated with the help of a function, NPV. So without going and calculating this big formula, you can simply calculate NPV directly like this. So you will get the value of this. Of course, I have something to do with this, so that I have done in the long way as well as in the short way. If you want to estimate in shorter way, you have to use this formula. Okay, so this will give you cumulative NPV, but I need individual NPV so that I have estimated all these values. For each outcome, I have estimated over here, but if you want cumulative, you can go for this. And then the next step, right now we know how much amount of profit that is going to be generated. We have estimates, that is the one, 7,31,249 is the profit that can be estimated at the end of 11th year with the discounted cash inflows. But without discount cash inflows, $8,60,500, that is the one which we can expect at the end of 11th year. And this is the one that we have estimated. And let us see the difference between NPV and investment. So NPV and investment, already the profit is over here 0. So no need, already we have the profit and NPV investment here. So 0, no need to do that. Okay, let us go with IRR, that is internal rate of return. As I said, what is IRR? Internal rate of return is the value of discounted rate that will tell you to get outcome of what you have invested. If you have invested $100, at what discount rate, at the end of what time, you will get that $100. Simply to say, you invested $100 right now. At the end of 2 years or 3 years, with discount price of 5%, you will be getting $100 back. But that 5% is the key. That is the one which is IRR. Is it 5% or 6%? Maybe 6% it might take. Maybe 7% it might take. So what discount percentage is required to get that investment back at the end of given period. So right now we have given period of 11 years. At the end of 11 periods, up to what discount price it is okay to get that amount back. So here what we're going to do is, like, we are going to estimate based on the target years, like time. So you have 11 years time. Imagine 11 years, of course, in this project, you're getting positive. But imagine there are certain projects out there where the values that I have estimated will become negative. Means we don't know when we will start seeing the profits. So here we have huge profit, that is 73,000, sorry, 7,31,249. But certain projects, when you calculate this, you will be getting value in negative, minus. So imagine if I simply, if I could change one value over here, like if I include one more, if I reduce 10 here, then you can see, not 10, if I have to increase one more zero, then you can see the values are negative. So there could be some projects where since you are not getting the investment that you have invested here 10 lakh dollars. So you can see the values observed to be negative. That means you haven't reached profit yet. So we don't know at what year we can get this profit to reach that value. So in that way, I'm telling. So currently our project says we have invested only 1 lakh since it is profit. But IRR will help you to understand at what year, like you have given a target year of 11 years, at what discount rate it is required to reach that investment. So let us try to estimate this value. You will be understanding. Just observe the value of profit and observe the value of NPV after estimating the value of IRR. So I'm going to just simply click it. I will write simply IRR. So this is the function that we are going to use to estimate the value of IRR. So it is asking the values and it is asking a guess of rate, but don't, there is no need to put the value of discount rate over there. You can leave that area as blank. So the values it is asking. So what are the values that you are going to put over here is not the NPV values. You are going to select from the investment which should be in negative. That is the first cell. Then after that, how many outcomes are there for every year that you have to select it. So we have selected the investment amount as minus negative. And after that, we selected all the values of every year cash inflows. That is 30,000, 38, 5,000, like that you have calculated for every year cash inflows. Just this is what it has been selected at IRR. Close the bracket and just get. So what is the outcome over here we are expecting? It will give you the discount rate. It will not give any value, but just it will give you the discount rate. So it is observed that with 49% discount value at the end of 11th year, you can get the investment that what you have invested. Of course, we are seeing the profit over here, but this answer what we are getting is the least risk. Here the risk is, like, imagine point, this is 2%, but you can increase the discount percentage from 2% to 49% until that you see the profit. So beyond 49%, then you can estimate that the values will go in negative terms. So the risk is up to 49%. So let us try to just alter a little bit the question. Like imagine we have IRR of 49%. So what I will do is simply I will just change the value of I will change the value of discount percentage, which will be equivalent to IRR. So this is what I'm doing. So that what is the outcome of this? Imagine if I am making the value of discount rate as IRR, what could be the value of this? Just try to estimate this in your mind. So I'm going to put this value so that you will see what will happen over here. So earlier discount rate is 2%. Right now I kept the value of so discount rate as IRR, and I am going to enter. See the changes what you have seen over here. The value at the end of NPV, discounted value, is 1 lakh, which is your initial investment. So you invested 1 lakh at the end of 11th year, exactly you got the amount that you have invested. And the difference, what is the profit? Zero. The profit you have it, he up to now, it is not zero means it's not loss, neither profit. So you came to balance, like you came the place where you got that amount back. So this is the kind of potential IRR has. So for 11 years, it is telling you you can take risk up to 49 percentage. So currently we have discount rate of 2%. But if I increased up to 49%, still you haven't reached the loss. You have came up to the balance side. Like, you reach towards a place where you got all the investment back. It took 11 years. Why? Because you have given the time up to 11 years. And it has told you the risk can be extended up to 49 percentage of your discount rate, so that only you can reach to this value. So if you could start moving forward, then you can start witnessing losses. That means what? It could take even more time. So if you increase beyond 49%, it will take even more time to reach that $1 lakh that you have invested. So this is what the technique of IRR, and I'm going to make this not 49 percentage, but the one which we have done earlier. So let it be as it is, like 2%. So 2% is the amount that was given in the project. So we will keep the data as it is. Next comes payback period. So at what, like we know that we have reached at the 11th year, we got the profit, but at what year we crossed the investment period? Like imagine maybe at the end of third year or fourth year, we might have got all the amount, whatever we have invested. So that we have to calculate. So how to calculate that? For that, we need to estimate cumulative cash inflows, cash flows. So what is the formula to estimate? For the first cell, we are going to select the investment plus the present value of first income. Just enter it. And we are going to use the first value. So I'm going to make this as log. So for the second income, don't continue with this, but the second value, the formula will be different. So it is minus 70 since that is the first income. When it comes to second income, just select the cumulative outcome of the first cell plus the cell of the second NPV income. Select it. Then from there onwards, you start moving forward. So it will be starting to select the values over here. Like that, it will start going. So it will go on continuously calculating the values. So we have actually first year we have the value over here, and the second year here I have done a mistake. Actually, this is the value, and when it comes to this value, yeah, no, it is not a mistake. It's right only. Yes, I think it's right. There is no mistake. So this is how the formula will be continued. First of all, we need to put the value of initial investment plus the first year NPV that you have to select it. From second year onwards, you need to add all the NPVs to the earlier cash inflows. So second year NPV plus earlier cash inflow, that is the cell, and third year NPV plus cash inflow, that is the cell. Fourth year NPV plus cash inflow, that is the cell. Fifth year NPV plus cash inflow. Like that, you have to go forward. So after this, what we have to do is payback period. You can estimate from this one. So is equal to the formula to estimate payback period. First of all, you need to identify the last negative value, that is at the end of second year. So if it is at the end of second year, select the value of year as second. So this is the value I have selected. After this, I'm going to use minus. Then the value of what you got it as cumulative cash flow at second year, that is the one we are going to sell. But before that, I will start a bracket. So I'm going to select the value of the cash cumulative cash flow at the end of cycle. This is the last negative value, cash flow by the third income value, NPV value that you have to select. That is this third income value. Close the bracket and just select it. So you have payback period of 2.74. So 2 years 0.74, the value was 74 value was given, but you have to convert that into months and days. So first of all, we have the value of this as 2 years. So 2 years is confirmed, but 0.74, 2 plus 0.74 will give you 2.74. So 2 years and 0.74 days. So we need to estimate months as well as days. For that, what you have to do? So 2 plus 0.74, take that decimal value, 0.74. 0.74 into how many months are there? 12. So you have 8.88 months. So this is how months can be calculated. So in that 8.88 months, just take that the value of months as 8. And from this value, take the decimal values. That is 0.88. You have to convert it to days. So 0.88 from the months into days. 360, sorry, a day in a month, sorry, how many days in a month? 30 days. Let us take 30 days. If you are estimating 8th month, so 8th month will be August, maybe 31 days. So you can just put it as 31 days. So you will be getting 27.3 days. So 2 years, 8 months, 27.3 days, you are going to get your total money that you have invested. So this is what exactly to estimate the value of payback period. So after that, whatever you see are all related to profits. So you can start estimating to observe the profits in discounted values. So this is the profit probably without discounted value, but after that you are observing these values are the profits with discounted values. So this is how you can able to estimate the payback period, internal rate of return, and NPV, that is net profit volume. So these are the things that we are going to discuss today, and in this course, uh, this is the one which is related to economics. So there are a number of things that are connected with the reservoir that we are going to discuss. So hope this has a good insight that you might have understood about the concept that we have discussed. So I'm I'm ending this session right now. So hopefully we are going to meet in the uh, a session that is going to be continued with the full course. And thank you very much. So I'm going to end the session right now. Over to you, Nikhil.